No, and actually, I just to rebound on what you said globally about globally, Helen. I mean, I read something in the a couple of years ago around the ERISA investors in the U.S., the retirees, and it was something said about funds, commingled funds, putting ESG language where the retirees in the ERISA plan, they expect only performance, and anything that is interfering with performance is because it's about paying pensions, could be seen as an evil, for lack of a better word. So how to manage that? How maybe to for once bring the U.S. towards following Europe?
No, you're quite right. I mean, Europe has been a leader, is still a leader. And I remember distinctly, I mean, it's probably not 2 years ago, more like 5 years ago. I remember sitting around an advisory board table with a large US investor who was absolutely adamant that ESG should not be mentioned. This was 5 years ago, so it's not that long ago. Because they were worried about the impact, because in their minds, they thought that ESG would end up costing them something. And I remember having a very robust debate about how ESG actually will improve the value of the investments, but it took quite a bit of discussion. So the global aspect of it, I think, is absolutely essential, and we have to get everybody on board at the same time. So I think that there will be probably some compromises to be made in terms of having these sort of standards, but we've got to push ahead. If you look at public markets, they're already there. So we need to be in the same ballpark.
Just on the US, as we co-invest often in the US, there's a very significant, I agree with you, lag between the US situation and the European situation. And in the US, the more you go south, like Florida, Texas, the more fund managers don't even know what's the need for ESG. It starts to emerge a little more in the northeast of the country, and California will be mixed. That's on one point. So this is still not a major criteria, and I don't feel that a major pension fund or some significant institution are still very active into this, except some of them. And the second point on what we do sometime in the office with real estate, there's also a confusion between the goal of the manager, the regulation from Europe, for instance, that you have to follow, the country regulation, which is different, and LP expectation, which are different when you do some things on infrastructure on a building. So it's still not there. I think in the corporate environment we're closer, but in some major topics we're still not there. But it's moving well. Yeah.
So probably some work to do in the U.S., Pauline, especially with the because that's where the big, well, like it or not, I mean that's where the most of the money still is in our industry. So there's a bit of work there.
There's a big market.
But that's a good point. I mean, a lot of the money, a large part of the money, has always been with the big pension plans. But now we need to talk about the democratization of private equity, and in the hands of the individual, and the individuals care about ESG. So there will be pressure coming from the individuals as well, I think.
You're completely right. You're completely right. And actually, I mean, maybe away from talking about. I mean, it's good. We did not mention the word carbon too much because that's what we feared as we prepared the panel, is that we'd be talking about carbon all day, which is, I think we've done well so far. But still, nevertheless, moving away a bit from the from ESG as a whole, focusing on diversity and inclusion that has made now its way to the advisory board. I hear. I mean, I mean, is it really now an expectation from investors, and also what are the challenges associated to it? So I'll look to you, Ellen, on this one.
So I think we've made some good progress over the last 5 years. I want to start on a positive note, but we're still not great.
You're always positive.
I try to be positive, but we're still not great on diversity and inclusion. Why does it matter? Well, I think it comes back to performance, a little bit like ESG. I see ESG as a way of creating value and preserving value. Diversity and inclusion is important because more diverse groups of people fundamentally make better decisions. You fall less into the trap of groupthink. And therefore, yes, diversity, you ought to be keen on it because it's the right thing to do, but it's actually the smart thing to do as well, because it's going to create better performing businesses, better performing corporate businesses, but also better performing managers. And this industry is incredibly performance orientated, and that's why this industry has to care about diversity and inclusion. So I co-founded Level 20 in 2015. For those of you that don't know Level 20, it's a non-profit organization which was set up to encourage more women to go into private equity and to stay in private equity, progress within private equity, with the thought that this will actually improve the attractiveness of the industry and the performance of the industry. And now you are seeing it now on the agenda of advisory boards, actually even on the agenda of annual meetings, so that it is a real subject. And it's going to take time, because you can't just parachute women and more diverse groups of people into managers and into teams of people. But what you can do is start feeding the funnel at the beginning. And some of our managers are now making a huge amount of progress in terms of the people that they bring in at the bottom of the pyramid, and then as they progress them going through.
And maybe an important point that we could make is that we talk that we need to adapt to the investors' perception. That's for sure. But we also need to adapt to the underlying portfolio companies. When we mean diversity, the way companies are sensible to diversity is obviously entirely different. If you talk to a family-owned mid-market company in the south of Spain or in the north of Sweden, then if you talk to a digital-born, very young company, obviously, diversity is not perceived the same way. And, for example, the way you deal with big data has absolutely no sense for a mid-market, mature industrial company, and is obviously a huge topic. For example, when you are called Doctolib and when you accumulate data on health, obviously, the topic is entirely different. So it's not only that we need to adapt to our investor needs, it's also that our industry needs to be prepared that our entrepreneurs, our managers, our portfolio companies can't behave all the same way. It's probably a little bit different. Hélène, you talk about the fact that the listed companies, the asset management company, the asset management industry is much more mature than we are. But it's also that when you are listed, your set of constraints is relatively similar. But obviously for us, it's entirely different. We also, in our case, we also have a private debt activity. The way you can decline ESG goals in a private debt, well, you are not a shareholder. So obviously your influence is entirely different. So this is key in the way our industry will impact companies, is that we need to adapt to each stage and obviously to each form of financing.
No, and actually, what's interesting is that we're very far from quotas imposed bottom up. We're more in, as you said, positive. What can diversity bring that is positive, and that's why we should do it. And it's not imposing at the expense of performance and everything else. So it's a positive message.
It's also important. I mean, coming down to sort of the corporate level as well. If you've got a diverse group of people in the portfolio company, and you turn up with a manager with everybody looking the same, that's not going to be great. And again, going back to performance and managers that want to perform and want to originate better deals, the manager that's more diverse has probably got a much better chance of winning that deal against a manager which is less diverse. So I think it's in everybody's interest to move along this path.
And Pauline, maybe any questions on any topics there? Is it also measured as part of your
sure
your solutions?
Well, diversity is included in the S of ESG, as in social, and in fact, yeah, it's one of the key topics. I think that the pressure is going from everywhere on that point. On the corporate, it could also even be the brand that is that is pressured to be more diverse from the consumers. So it's going from everywhere, and I think it can be measured, in the Novice tool, obviously, but also I think that doing that in the positive way, one of the key is to measure it and track it from the beginning. Do not wait 2 weeks before your IPO to see if you've got a diverse board. I mean, it's not the way you want to do it. And yes, it could be one way to. One of the benefits of having a reporting on the diversity is that you can see the improvement of diversity as an objective. It's not something you want to do with quotas and parachuting people. It's an objective, and you know that if you target it, you'll have a better added value and a better team.
I mean, very interesting. And I'll make a comment that I mean, looking at Olivier, I mean, I think that we'll give I'd say illiquid assets a very big pat on the back. That it is. I mean, whether we're not where we should be yet, at least we're thinking about it and doing things in a positive way. What's your perception, Olivier, on the more liquid strategies? I mean, do the managers you work with on the liquid side do they look at these at diversity, inclusion as part of their frameworks, or is it just performance?
On the liquid side, there are probably different attitudes. First, just to recall the difference between liquid and illiquid, because it's
we're getting definitions now.
No, yeah. It's very, very short. With illiquid assets, you can basically sleep well all the year. You get 1 day of valuation. You can have your whiskey this day. That's all. On liquid assets,
we wish probably
every day you get the value of your assets, and this creates a different pattern for the people. So you have short-term people, longer-term people. I would say that on liquid assets, except institution, most of the investors, let's be frank, are not very, very reluctant to look at ESG at a first sight. You have a lot of people who want to avoid certain areas. But what has changed in the past maybe 2 to 3 years is that a lot of carbon heat industry, like steel, like concrete, like a lot of those business, are viewed in a different way, and that people are very reluctant to invest into that. So it has a certain impact. The second thing is the alignment of interest between the cost of capital in those business and in other business. The cost of capital of business involved in oil, in steel, in all those businesses is becoming higher and higher because they have a hard time to raise money, and the debt funds who lend them money ask for CO2 reduction target. So this is another change. And then you have the alignment of interest between the management and the shareholder, which with the market will stay always a little different than what exists in private equity, where the alignment is one of the recipe for success. So those things are changing in a significant way, I think.
Interesting. So maybe moving towards another aspect of the LPGP relationship, talking about platforms, because well, the leading private equity firms have become or are becoming platforms. It's a fact. So my question to the panel would be what is it that investors gain or lose versus the single strategy model known as being part of the Yale model, where it's one team sharing in one carry, and that will make or break depending on the outcome of one fund. So I mean, Olivier, any thoughts on this?
Yeah, maybe I'll speak later about that, but maybe the three main topics.
As you wish.
Yeah, no, is that a platform works historically well, is like we spoke about it in the hedge fund business. You have a very successful debt manager who gather around him other specialty. So I think that in the private equity in the last 10 to 20 years, you have very, very successful stories who started in the States, who are happening as well in France with, for instance, my neighbor or other, where around a very, very strong group of people you gather other kind of assets. I think there are still 2 or 3 business which are not very linked to platform, which is real estate, for instance, which is always a little of tendency to have
Christophe has one on the platform.
their own platform. and venture capital is an exception as well. But if you take a platform from north of Europe, they get rid a little of that. So it's different, but there's a lot of economy of scale with the platform. There's a lot of trust created by the brand and by the partner. And of course, there's a way to gather all the investors in different channels, which is very, very successful.
No, I mean, they're there for a reason. I mean, Christophe or Helen, yeah.
Maybe on that, there are pros and cons, and you mentioned it, Louis, on each business model. There are pros and cons to be a single fund, GP. There is also pros and cons if you are a platform. If you are a platform, you obviously we have been an independent GP, and we join forces to become a significant platform. So obviously we have less entrepreneurial spirit than before, maybe. But if you have the cons, you need to have the pros. And it's just this equilibrium that is important. For example, in our case, the benefit of being a platform, among the different benefits of being a platform, that your ability to help your company to grow internationally is much stronger. We have 6 people based in China. Not each one of our portfolio companies is expanding in China, but if a portfolio company intends to develop in China, we obviously have an organization that a platform can offer. And this is also true, if we come back to ESG, this is in the value added that our portfolio companies are expecting from us. It has been clear during our panel discussion, ESG is not a mature topic. It's something that you need to adapt. But nevertheless, in the expectations today of our managers, the way you can help them to do build-ups, the way you can help them to expand internationally, and the way you can help them to translate all these ESG principles that we presented today, how you can help them to decline it in the most efficient way for their own specific case. And again, it's entirely different if the company is digital born or if it's a mature buyout. This is clearly something that is expected from us. And in our case, it's also something where we have the perception that being a platform and having an organization fully dedicated to ESG helps.
And actually, Helen, forgetting that Pantheon is also somewhat a platform, maybe with your LP add-on, what do you see with your perspective from an investor in many funds?
Yes.
Pros and cons.
No, I mean that absolutely pros and cons, getting the balance right. I mean, Christophe mentioned sort of central ESG resources. There's also other sorts of central resources that you can use. I mean, we see it all the time with large, very well developed managers that have got central resources to help their companies with digitalization, with supply chain, procurement. When COVID hit last year, some of the managers that were the best prepared were the managers that had these central resources that could quickly deploy them to the underlying portfolio companies. And again, global managers that had seen what had happened in Asia and could apply the principles and the ways of helping these businesses to their European businesses and then to the American businesses when COVID sort of rolled out throughout the world. So there's definitely advantages in lots of different aspects. The tension there is between the very big platforms and large organizations versus the entrepreneurial spirit and the sort of the live and die by one strategy, by one type of business. So there's no one right answer, I think.
And there's no question on the alignment for the latter.
No, exactly. No, the alignment of interests is probably the thing that we have to spend the most amount of time on when we look at a manager that's part of a bigger platform. So getting that alignment of interest right, understanding the cross-incentivization, that is absolutely essential. It's a more complicated story sometimes for the investors.
Thank you. Olivier, one last comment before I open to the floor for an audience for questions.
No, a platform has significant economy of scale in fundraising, for instance, investor relation, cost of capital, different specialty, like you said, logistic procurement, Nevertheless, I think that sometimes in reporting, sometimes in the way some relations are made with investors in very big US firms or whatever, it becomes a little too far from the investors. And sometimes in like venture capital or different specialty, you might like a little closer from the assets than it seems.
Maybe a bit too slick, a bit too corporate.
Yeah, maybe.
The audience, any questions for the panel? No? No. Okay. So maybe just a question. I think so you mentioned, Olivier, maybe in the investor relations, the idea that everything is a bit too slick. I mentioned the alignment, and actually, I mean, there are pros clearly to platforms, and they're there anyway. How do you make sure, maybe as an investor or as a GP, that the teams that you invest in want to stay and that they're aligned?
Well, that's the essence of the issue, I think, and it takes a lot of time and a lot of time spent with the manager, actually, to be able to dig through exactly what the incentivization programs are and how much of the carry goes to different teams, the succession plan that they have in place, the transitions that they have in place, and all that is complicated a lot more when you've got a bigger platform. So it's not impossible, it just takes more time to kind of cut through it. And there are benefits as well, because in a small organization, you often have key person risk. So that's another type of risk, which maybe in a larger platform, there are more people that could be moved into different positions. So it's swings and roundabouts, as we say.
And maybe a last comment that we can make on ESG issues regarding the way we interact with our entrepreneurs is that when today, what are we financing? We are financing fast-growing companies that are top-notch companies. And what is their major issue today? Their major issue today is not capital. There is liquidity everywhere. Right? So the best ones, they care for capital. Everybody is caring for capital. But it's becoming a smaller issue than it was in the past. The real problem today for them is a scarcity of talents. They want to attract the best young talented that we look for every day also in our organization. And today, when you explain to a manager, if you want to attract these specific people, and if you don't have any ESG speech, any ESG structure, if you don't talk about the meaning of your company, if you don't have anything to tell them when you want to recruit them, you will lose them. This is something that has significantly changed, and it's good for the future because definitely it's coming from the bottom of our industry. It's coming from the portfolio companies. They are giving us a message that if we don't help them to structure, to adapt their message, they are not able to recruit the best talents. And it's key at the end of the day for our financial performances that are still an important issue for all of us. If we are not able to have the right talents, we can't deliver.
I couldn't agree more. Sorry, we're in danger of violently agreeing with each other here. But I'd just like to add something else, which is on diversity and inclusion. Because when we have new people that come into our business, they are looking at the other people around them, and they want to see people that look like them, and they don't want to see people that look, just like one format. And that's incredibly important. And when people do their due diligence on us as they're coming in as employees into our organization, they are asking totally different questions, the sort of questions they asked 5 years ago.
And just on this subject, I mean, I promise the organizers not to ask a controversial question. So let's talk about linking carried interest to ESG goals. I mean, is it something that you see investors asking?
It's definitely a trend that is here to stay at the end of the day, and especially when you talk about dedicated mandates. When the investor is able to give you some specific goals, obviously, there is a natural trend to link fees. It can be management fees. It can be, obviously, reporting guidelines, can be plenty of different aspects of the organization of a dedicated mandate. But at the end of the day, as we all know, one of the major KPI of our industry is performance fees, it's carried interest, and yes, more and more, it is linked.
So you see now that there could be a portion, or there will be a portion of the carried interest that will be linked to ESG goals.
And it's easier. Well, we have a huge trend on reducing the level of carry if some KPIs are not achieved. We are fighting. It's a little bit more difficult to also have the compensation and to say if we are outperforming on some non-financial goals, we can have, let's say, 22% of carry. It's a little bit more
you'll
difficult.
get it in the multiple, because if a company that is doing well on the ESG is worth more, well, then you'll get it in the EBITDA or sales multiple that you're selling for.
No, that's a key conviction today. Yes, it's a way to reduce risk. It's a way to enhance performance. And today, when we mean ESG, we mean business. It's not something that is floating in the air and different from the daily business of our portfolio companies. It's definitely a way to reduce risk. It's definitely a way to increase the exit price.
Last opportunity for the audience, if there's a question. Here there is. Can someone give the mic to the gentleman, or if the gentleman can speak up?
Yeah, I can speak up. Just how do you position in terms of the SFDR regulation? How is it going to influence or not your investment decisions, as the LPs?
Can you spell out the acronym, because I don't know it?
Sustainable Finance Disclosure Regulation. So this regulation that was put in place this year, asking for the classified GPs between Article 6, 8, and 9.
Got it.
Oh, yeah.
So how is it going to influence the?
Well, for all of us that are inside the European Union or that are raising money inside the European Union, yes, we need to classify your funds in Article 6, 8, and 9. And there is a huge pressure, and we are not the only one to perceive it, there is a huge pressure to increase the number of Article 9. And there is an even more pressure, even more important on, an Article 9 means something, but an impact fund is something a little bit further on, and it's definitely there is a huge trend, but we need to respect it. And each one of our vehicles now are ranked among these different, and it's making the industry progress. It's putting a huge pressure on our industry.
The listed assets for that are a little in advance, maybe, because if you want institutional money, you have to be 8 or 9. In private equity, we can say that we want to be 8 or 9, and there's a little lag that probably the industry have versus listed assets.
Yeah, it's on its way. I mean, I think infrastructure actually has led the way as well. So definitely something that is not going backwards; it's going forwards.
Well, thank you very much, everyone. So the clock has gone red. Our time is up. Please join me in thanking our panel, and thank you.